And then the other opposite of stocks, of course, bonds are, man, this is again, doing this 20 years now, this is the biggest rout in bonds I've ever seen. I think this is the worst month. March is the worst month. Now, I don't know about the last couple of days, but this month is the worst month in the last 46 years, total return.
Wow.
That's just
incredible.
Unbelievable. Yeah. So you have conservative investors who, 70, 80, 90% of their portfolio is in bonds and wondering why their portfolio is down is more than some more aggressive investors. And it's because I think the perception of rates going up, interest rates go up, bond prices go down. That's the typical association. And everyone thinks rates are going up a lot. And the Fed increased rates to kind of reinforce that idea. And man, it was just it's been a rough month for stocks.
Yeah. A lot of conservative investors who have that bond allocation, they're always thinking, well, in times of volatility in the stock market, at least we have the safer side of our portfolio, which is the bond side, right? Relying on that income stream from dividend, paying stocks or the bond side. And I think just helping them to understand why the bonds are as down as much as they are this year. And like you said, it's the largest drawdown in bonds in 46 years. It's pretty incredible stuff when you really think about it.
Yeah. And the other big topic of March was the 2 and 10-year Treasury yields inverted for, I think it was literally a minute. I didn't look at the market today, but or the Treasury curve today, but yield curve today. But and so historically, that's been a signal of potential a looming recession, usually in the next year or two. And this brings out like all of the doomsdayers on Twitter. If you're on Twitter, I call them Twitter muscles. It's like people can't wait to tell you why things are going to be bad in the future. And it's just, it's like something like this happens. And then it's just like everybody, it's like mice scurrying out into the light and then getting on their keyboards or their phones and typing, the end of the world's upon us because the yield curve inverted for a minute.
The keyboard warriors, right? Another term for them. Seems like they come out in bunches in these times. It's funny you say that. I was watching what we call the talking heads on TV today. And one of the moderators said or posed the question, is our fate doomed for recession? Is it cemented for next year? I'm thinking, how is that cemented in any way? I mean, I know that it is an indicator of recessions in some cases, but it's just funny that, it inverts for a minute and we're already talking about our fate is cemented 12 months from now.
Yeah. And I know Ed Yardeni, who's just super smart and analyst and has his own firm, Yardeni Research. He looks more at the 10-year versus the 3-month rate as opposed to the 2-year rate, and we're nowhere close to inverting there. And the reality is that the last 7 times this happened, that there was an inversion of the 2 and 10-year yields. 1 year later, the average return of the S&P 500 was something like 11.8%. So no time to panic. I wouldn't say that. There was a down year in those 7 times, and that was right on the kind of the verge of the dot-com bubble. So, it doesn't mean the market's going to go up. It doesn't mean the market's going to go down. I think it goes back to our conversation from last episode, which is it's important to tune out the news and just focus on what you can control and then move forward from it.